last video we have seen short-term liquidity ratio and long-term liquidity ratio. In this video we are going to see asset ratios. Asset ratios are otherwise called as performance ratios or efficiency ratios or turnover ratios. Why they are called asset ratios? Because we compare assets to turnover in this ratio, so that how the assets are effectively used, we can derive from it. So we call it asset ratios or turnover ratios. We can also call them as efficiency ratio, how efficiently assets are used. So they are called as efficiency ratios or performance ratio, how well the assets are performed, how to generate business. So they can be called as asset ratio, turnover ratio, performance ratio or efficiency ratios. In that, first we are going to see total asset turnover ratio. Total formula is total asset turnover ratio is equal to sales or cost of goods sold divided by total assets. We in this numerator is sales or cost of goods sold. Cost of goods sold, we take cost of goods sold, right? In that, cost of sales can also be taken if there is no selling or administrative cost. What differentiates sales cost of goods sold from cost of sales is selling and administrative cost. If there is no selling and administrative cost, we can take cost of sales. We can take as per the given in the question. So sales or cost of goods sold divided by total assets. From this formula we can derive how the assets are used, how effectively the assets are used to generate business. If the ratio is higher, then it indicates we have performed well. If the ratio is lower, then it indicates we have underperformed. We should have performed more. So basically in the turnover ratios, the ratio should be higher, so that it indicates that we are performing better, we are using our resources better. If we are not using our resources better, the ratio will be lower, right? First one, total asset turnover ratio. Second, fixed asset turnover ratio. The formula is fixed cost sales or cost of goods sold divided by fixed assets. Same, like first formula, similar to first formula, here is also the aim is to find how the assets are used. The only difference is there is in that formula we have used total assets. How total assets are performed to generate revenue. Here how fixed assets are used to generate revenue. So in case of fixed assets are old, the denominator will be less, so that the ratio will be more. It indicates that the fixed assets have been used much more time. If the fixed assets are new, then the ratio will be lower, because they won't be used as much, right? Next, current asset turnover ratio. Sales or cost of goods sold divided by current assets. There are in total assets there are two portions. As we have seen in liquidity ratios, there are two portions. One is current assets, another is fixed assets. Current assets, we have found total assets, we have found current assets. Here we are going to see current assets. Total sales or cost of goods sold divided by current assets. Next, capital ratio or net asset ratio. Same, the formula is sales or cost of goods sold divided by net assets. Here the aim is to find how the resources, that means capital, equity, owners fund and long-term borrowing are used to generate revenue. We are procure balance sheet. In balance sheet there are two components. One is resources and how we have applied. Basically they are segregated into two. Using assets we have found ratios. Now in this capital ratio, the aim is to find how equity, owners equity and long term assets how long-term assets are used to generate business. We have seen various asset or turnover ratios. One of the most important ratios is working capital turnover ratio. Working capital turnover ratio is equal to sales or cost of goods sold divided by working capital. Working capital is subdivided into three categories. First, inventory, second, debtors, and third, creditors. In those three, debtors and creditors move on same line. The only difference between debtors and creditors ratios is that debtors ratio, the aim is to find how frequently the payment being collected. Creditors ratio indicate the objective behind the creditors ratio is that how frequently the payment being made. The formula and everything behind the ratio are similar. Inventory, first we will see inventory turnover ratio. Inventory turnover ratio is equal to sales or cost of goods sold divided by average inventory. Average inventory is equal to opening stock plus closing stock divided by 2, or only inventory is raw material, then raw material consumed divided by average stock of raw material. Okay, the objective behind inventory turnover ratio is that how frequently the inventory is being moved. If it is so frequent, the ratio will be higher. If it is not frequent, the ratio will be lower. Second, debtors turnover ratio. Debtors turnover ratio is that credit sales divided by average accounts receivable. Why should we take credit sales here? In previous formulas we have taken total sales or cost of goods sold, but in this formula we are taking credit sales. Only reason is that previous formulas total assets are used to generate total revenue, but in the formula subjective is to find how frequently the payment being collected. So the payment is nothing but credit sales. So credit sales divided by average accounts receivables, we can find how frequently the payment being collected using another formula called debtors velocity or debtors collection period. The formula is average accounts receivable divided by average daily credit sales. Average daily credit sales. The formula of average daily credit sales is that credit sales divided by number of days in a year. Say 360 days. If 365 given in the question, we should take 365. If nothing is mentioned, we should take 360. There is another formula for debtors velocity, which is 360 days or 52 weeks or 12 months, whichever is given. If the question is given in months, we should take 12 months. If the question indicates in weeks, 52 weeks. If the question is given in days, 360 days or 365 days, whichever is applicable. If the question specifically given 365 days, take 365 days. If nothing is given, 360 days. We should assume it as 360 days divided by debtors turnover ratio. Using this, we can find debtors velocity. Similarly, creditors turnover ratio is that total net credit purchases. Net credit in debtors velocity we are taking credit sales. Similarly, we are taking credit purchases here. So net credit purchases divided by average accounts payable. Second, we similarly creditors velocity or payables velocity is equal to average accounts payable divided by average daily credit purchases. The formula of our average daily credit purchases is similar to the average daily credit sales. The only difference is denominator is 360 days in a year. That doesn't change. Numerator is net credit purchases are 360 days or 12 months or 52 weeks divided by average accounts payable. So in this video we have seen turnover ratios. In that there are 5 turnover ratios: total turnover ratio, fixed asset turnover ratio, current asset turnover ratio, working capital turnover ratio, capital turnover ratio. Of that, working capital turnover ratio is subdivided into 3 ratios: inventory turnover ratio, debtors turnover ratio or debtors velocity period, or creditors turnover ratio or creditors velocity period. In the upcoming videos we will see uh, profitability ratios. Profitability ratios, again there are many ratios in profitability ratio than compared to short term liquidity, long term liquidity and turnover ratios. And we will see the pros and cons of ratio analysis in future videos. Thank you. Have a nice day.